Hello, everyone. Welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today, we're going to be looking at a well-known company. And if you're in the e-commerce space, you will definitely know this business. So we're going to be looking at Shopify today. So some interesting things to note about Shopify before we go into the fundamental financial analysis. And bear in mind, we look at the annual audited reports. Now, a bit of history about this company. Canadian business, founded by Tobias Lutke and Scott Lake. Interestingly, they were creating an e-commerce company called Snow Devil, so winter sports. They were not really happy with the e-commerce application on the website. So Tobias basically created one, and that became Shopify. And since then, they have grown immensely. And you will see the latest reports showing what their growth rate has been. But they've grown a lot. They've been acquiring a lot of companies. And what's interesting is when you look at their website, what they say is literally what they say here is everything you need to sell anywhere, right? So they are trying to capture a very, very big space here. So everything from points of sale services, online store, buy button, kind of checkout button. They do things around marketing when it comes to, websites, email marketing, business chat, even Facebook chat. And they're even involved in kind of the managing and logistics. So involved in fulfillment orders, shipping, payments, etc. So they're trying to capture the market in its widest sense and really kind of corner this whole industry for the e-commerce space. So stick around because we're going to be looking at the finances. We're also going to be looking at the share price as well. And we're going to talk about the market capitalization, the yield, the dividend yield. But just to give you some context in terms of how that share price has been moving. So if you invested in 2018 when they went public, you'd be sitting on a profit of about 225%. Not bad. 5 years, again, 225%. But in the last year, they're down around 69%. And that seems to be reflected in being priced in terms of recession and consumer spend, and therefore the income that they get from those transactions. It seems like the market is pricing that in. So stick around. We'll talk about that a bit more later on. So Ted, let's talk about the financials of the business. And especially, we're probably going to see things around their sales and marketing and the investments there. One note for anyone who's an investor watching this, they have announced their 10-to-1 stock split, which is due to occur on June the 30th, I believe. And that is their both Class A and Class B shares. So it'll be interesting to note how the share price moves then. So Ted, take it away. Let's help our viewers analyze the financials of a company like this.
Okay, well, good to see you, Moeed. Hello to you and hello to all of our viewers. Here are the accounts from Shopify, sorry, their F40, which is filed with the SEC. So we are now looking at the income statement. This is page 103, 192 page document. So we're about halfway down the document. We are dealing in dollars. Okay, so just in dollars, or sorry, when I say dollars, we're dealing in thousands of dollars, my mistake. So when we show revenue, for example, this isn't 4.6 million, this is 4.6 billion dollars. Now you'll notice that they have split out the revenues between their subscription solutions and then the merchant solutions, the kind of point of sale stuff, and then they've got the sale and the merchant. Now the reason for that is that they want you to be able to see where the profitable business is. So I can tell you on the analysis that the merchant, sorry, the subscription, they make about an 80% margin. So that's very, very profitable business, and it's growing at 48% year on year. So that's this growth rate going on up here. So it's the smallest part of the business, or the smaller part of the business, but it is a 48% and it's growing. So it's growing at 48%. It's an 80% margin. Every dollar they bill their clients costs them 20 cents to deliver that service. The merchant is a little bit less. It's not massively less. It's a 43% gross margin and it's growing at 62%. So it's higher growth, but lower margin business. And overall, if we take an average We are seeing revenues growing by 57%, so nearly 60% overall, and they're making about a 54% gross margin. So, you know, basically for every dollar they bill, it's costing them 46 cents on average, which is pretty good. That's pretty that's a pretty good and a pretty profitable business. However, they are spending an awful lot of money at the back end. So here there's their sort of their operating costs. There's a lot on sales and marketing. There's a lot on research and development, and the R&D. So the admin is a lot less. So there's a lot of marketing going on. Moed, as you were talking about, they're into lots of different areas. They're obviously doing lots of development of you know, sort of new functionality, etc., and they're spending $1 billion on that, and $1 billion on the sales and marketing. So really, really hard pushing, and that really means that they are making next to no profit at all. You know, in terms of that operating profit margin, we're talking about 6%. Which is better than last year when they were off at 3%. I mean, that was pretty much at break even. Now, what's interesting about this company is when you get down to the bottom line, there's the net income, which is $3 billion. Wow. So they're making a $3 billion profit. How can they be doing that? And the answer is here. Okay, so they've made this, now this is an unrealized gain. So it's quite interesting that they booked this through the profit and loss account. This is an unrealized gain on equity and other investments. Now, I don't usually do this. Usually we're just looking at the kind of the top level and giving a kind of an overview, but this is such a big number and so fundamental. I kind of feel that we ought to go and actually have a look and see what is going on here. So this is note 6. So let's go and have a look at note 6 and see what is going on there. So here we are at note 6, the accounts. So always dig around in the notes. It's always worth having a little look. And what we see is this investment with the terminal fair value has gone from 0 to 3.2 billion. Wow. So what's going on here? So it seems to me that this is the big driver. So a firm. So what happened here is that they received an investment in a firm as a non-cash revenue consideration. So that's basically saying, I need to buy your services, Moe. I can't afford it. So rather than paying you in cash, I just give you some of my shares. It's a bit like, you remember the story, the old days of people being paid in Bitcoin, and they went, yeah, whatever, and forgot about it, and they'd be billionaires today. Well, that's kind of what happened to these guys. They were paid $24,000, about $25,000 in shares. And then as a result of this company's flotation, these shares are now worth, you know, $2 billion basically, which is substantial to say the least. You know, given that it was the payment was made in 2020, and now you've got this sort of 2021 they floated, and there it is. It's valued at $2 billion. So I guess the point we're going to make here is that you're not going to see. You didn't see that last year. You're not going to see that next year. So that is a substantial one-off profit. Now, we might just leave it there.
Interesting and ironic that a firm is a buy now, pay later business as well.
Yeah. So it's you know, we might just leave it there. But then I suddenly started to think, well, hold on a sec. You know, that was then. What about now? So let's go and have a look at a firm. So I've identified when they actually have valued this. So they valued it on the 31st of December, okay, and the stock on that date was worth $100 a share, and today it's worth $20 a share. So that's fall of 80%. So in my books, if the value of the share has gone down by 80%, and don't forget, it can carry on going down, there's nothing to stop it going all the way down to 0. So if it's gone down by 80%, and they are trying to realize, they're trying to value it at fair value, then I would suggest that that valuation needs to go down by 80%. And therefore, what we're going to see here is a shocking great loss booked in their 2022 accounts. Now, I may be wrong. I may have completely got the wrong end of the stick. And if I have, I would be very grateful if one of our viewers could please put me right. Obviously, you can be polite in the chat, but please do put me right. But otherwise, I think that if you are going to buy this company, you're going to see a big hit and a big loss in 2022. That is my prediction. So there's the income statement. So, basically these guys, if we just ignore what's going on, and this is why we kind of tend to kind of, just don't worry too much about what's going on below this line. They're trading at basically a break even at the moment. So they are growing, but are trading at a break even. Go and look at the balance sheet now. And the balance sheets, we just could find the balance sheet. Here it is. So in terms of the assets, so the non-current assets have gone up significantly, and the reason for that rise in the non-current assets is that investment. So they've taken a whole lot of investments. They said, look, we made this investment, it was unlisted, now it's listed, we can value it at fair value. It's gone up. We haven't booked it through the unrealized income statement, which is what we would usually expect. They've actually taken it as a profit through the profit and loss account, and so they've now got a significant amount of non-current assets. The rest of it is pretty small, because they're a software company. You don't really need assets to run a software company. What they also do have is lots of cash. Okay, so you can see this, lots and lots of cash. So they did their fundraising. You were mentioning about a stock split. Moeed, you're talking about the A and B shares. Again, I haven't done my research. I apologize about that. But if you are doing A and B shares, you and I probably can buy the A shares, but the B shares will be the ones with the voting rights. So my guess, and that is purely a guess at this stage, would be that the A shares that you and I hold, well, if we buy them, you would have no voting rights, and so while the owners, or the previous owners, the founders, may not own most of the stock, they will certainly own most of the voting rights. So you can't get rid of them if you don't like them. So really, in terms of assets, these guys, they're just sitting on a ton of cash, and this kind of investment. That's basically the balance sheet on the asset side. It's cash and this kind of this investment, which I think will be going down next year. In terms of their liabilities, they've got a little bit of debt. There's $1 billion of debt there. It is there. And otherwise they've got what you would usually expect. So the accounts payable, etc., etc. But they've got so much cash from their fundraising. So when they listed, they raised so much cash, and there you can see the equity, here. That's where they'd have, and that's gone up. So they've actually raised a bit more equity during the year. Retained earnings has gone up, but that is because of that revaluation of their investment, not because they are trading profitably. So don't get distracted by that. There's the revenue. We've done that. So here is the movement in shareholders' equity. So again, just so we can follow this through, we're looking at the retained earnings. Here it is, and they're booking this profit. They're not paying out dividends for obvious reasons, because they've just done a big fundraising, so they're keeping the money in the accounts. There's the fundraising coming through the previous year from issuing shares, and here is the fundraising from issuing shares in this year. So they've raised a lot of money on the market by issuing shares. I'm expecting them not to issue any more shares. I can't think of why they want to, but they've got a lot of cash in the bank, and therefore they are in a pretty strong position from a liquidity point of view. They've just got to really prove their proof of concept of their business model, which is, as I said, at break even and not really making them a lot of money. So if we look at their cash flow, and the cash flow from operating activities, the cash flow from operating activities is relatively low. Now, the reason for that is that they've just taken out this unrealized gain. So here's the profit figure. Obviously, we said the profit figure is basically this kind of this my investment has gone up in value. So underlying, they are generating about $500 million in cash. So they're generating cash, and that's good. But it's not a huge amount that they are generating for the size of their business. The cash from investing activities, if we look at these numbers, we're actually getting a distorted number, because you'll notice up at the top, we've got purchase and sale of marketable securities. And this is really because they've got so much cash, they're just parking it by buying what we call marketable securities or bonds, which is, for you and I, we can just call it a deposit account. So they're putting money on deposit and then they're taking it off deposit. And that's what these top two lines are all about. So we kind of just need to just eliminate these two lines from our analysis and look, and there's the purchase of property, plant and equipment. You'll notice that they're not quite generating enough cash to be able to cover their expansion in terms of I'm on the wrong line there. Property, plant and equipment is a little bit further down. So this is investments in other companies, buying equity of other companies. There's a little bit of property, plant and equipment, but they don't need a lot because they're a software company. So that's just a couple of laptops for the lads, etc., etc. Here's their fundraising. So we can see the fundraising again. We wouldn't expect to see that anymore. They look like they've raised enough money, and they did they raised money through debt as well. So in the past they have been raising lots and lots of cash, and that is why they are sitting on a lot of cash at the end of the year. And you'll notice that this is just the cash. They've also got lots of marketable securities as well, which is for all intents and purposes cash as well. So actually, it's not 2.5 billion in cash they're sitting on. Just pop back to the balance sheet, and we can see their cash and cash equivalents, 2.5 billion plus the marketable securities. So that's nearly 8 billion of cash, making up pretty much all of their current assets. So this is a company. They're trading. They're growing rapidly. They're trading at a break even. They are producing some cash. Not a huge amount for the size of business, but they are producing cash. Their balance sheet is basically cash and this investment, and I think the investment is going to go down in value next year. And there's a little bit of debt there as well. So lots of cash in the bank, liquidity not an issue for them. So, well, there's their investment. Let's see how they've been performing. So here is Shopify, and we can see that they have really dropped right off the top. So if you've been investing at the end of 2021, you'd have been taking a very significant hit to your investment. Interestingly enough, no PE ratio. Now, I'm not sure exactly why there's no PE ratio. I mean, they're not paying a dividend, but I'm not sure why there's no PE ratio when they are, they do have this positive earnings. So, if I plug those, that valuation into my little computer, it tells me that they're trading on 60 times earnings, but then that earnings figure is an unrealized gain, and if we strip that out, then actually they're trading on a very high multiple of earnings. So it's either a 0 P ratio or it's many hundreds of times earnings. Either way, it looked to me like it's a very expensive company. Now this drop here, this will have been driven by the big tech sell-off. So the whole jam tomorrow, we're going to be profitable, we're going to make you money, but at some point in the future, that's less attractive in an inflationary environment. And as the central banks of the world realize that inflation is less transitory and more sustainable and more here to stay, so there's been this big sort of rotation out of tech and into the more solid businesses, and this definitely sits in that tech jam tomorrow. Although at least they are making a profit, they've got cash, they're going to survive, they're not going to have to go back to the markets, so they're going to be around. I can't see it really dropping a huge amount more unless the market has really cottoned on to the fact that there's this big hit coming from that investment. And I don't know to the extent to which that fall in share price is due to the fall in the value of a firm, or whether it is due to just a sort of a general sell-off. So it'll be interesting to see how the market responds to the next set of accounts, and what the company actually looks like as a result of that. So quite an interesting company, Moe. Certainly not for the faint-hearted. Certainly not for me. I can tell you that for a fact. Yeah, there we go. So I hope you found that useful and informative.
Yeah, I find it an interesting company. Haven't decided if it's for me yet or not, but certainly an interesting company. Would love to hear everyone else's thoughts, so do leave a note in the comment section. And if you'd like us to analyze a company that you're really interested in for whatever reason, whether you're investing in them or selling to them or thinking about joining them as an employee, do leave a note in the comment section, make that request. This particular one wasn't a request, but about 98% of the videos we do publish are requests from you, the viewers. So leave a note there, give us some context as to why it's important for you, and we'll make sure to post that. And if you're a subscriber, you will get instant notification when we do post your video. Make sure that you do subscribe and hit that notification button. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next one.
Okay, good to speak to you, Moe. Catch you later.